The infinite banking concepts is a process. Yes, they include the whole life insurance policy because it makes it more efficient, but it doesn't have to be included to have the infinite banking concept work.
There's many people out there that are like, what's the least amount of insurance can I get? Oh, $500,000. Are you serious? The disrespect that you're putting on your name.
Whole life has been bastardized so badly, it's just hard to make it popular again.
If you could give your dollars more jobs without taking on more risk, could you get better outcomes? Some people, not.
There's no could. There's no could. You would.
Newsflash, no asset checks all these boxes. When I'm talking to people, I usually give life insurance a yellow check mark, but I don't want to lose credibility with people.
But I think you're wrong having that be yellow.
So check this out. We're taking all the benefits that are green into our calculator. The calculator is now taking that benefit and bumping up the rate of return. So let's just do this in real time. I'll let you run the numbers. What do you want the tax rate to be? I want to talk from just a pure mathematical standpoint. I would be better off taking the 4%, taking the additional 2% that I would have paid the insurance company, not me. I would have more money in that scenario.
I could prove you wrong mathematically
Chris,
every
respectfully,
day.
You can't because this is like pure math. Chris Naugle, no introduction needed, bro. Welcome back to the BetterWealth Show.
Hey, it's an honor. Thanks for having me back.
So there's a lot of things we could talk about. We could talk about infinite banking. We could talk about arbitrage. We could talk about buying cars. I had a great conversation with Mr. Burr and also Brent recently about the car conversation. I also built a calculator that I think is pretty cool that I would love to show you before it hits the public and get your thoughts. I know I've, again, had you on multiple times. Define infinite banking, and then I want to talk about technology, because I find that if we don't have a clear definition, we can talk about all these things, but then people can argue about how you actually define things.
Yeah, the definition's simple. It's a process of taking back the banking functions in your life. In other words, how we give up our banking functions every single day, because that's what we're taught to do. We make money, we deposit it in the bank. When we need money, we borrow back from the bank. It's just the process of taking that back, taking control of those functions back. That's all it is. It's simple.
So how does whole life insurance play a role in that function?
You know, I sometimes have to tell people that, you know, the whole life policies, and I want to preface, a specially designed whole life policy. It's not an off-the-shelf whole life. I think people give it too much value and people glorify it a little bit too much, if you ask me. I think it's slightly better than what you could do with a bank account, you know, or a high-yield bank account. The one differential that I will say that makes whole life the chosen one for the infinite banking concept, you know, and it's not R. Nelson Nash because he said whole life is the best. It's far more fundamental than just saying, oh, this person said it's the best and did the studies on it. It comes down to two main things. The whole life insurance policy and just the way that whole life works is one of the only vehicles on earth that can allow you to earn an uninterrupted compounding interest while still using the money to solve other problems in your life. So that's fundamentally number one. But number two, and hopefully this reaches, you know, the majority of the people listening, is I care about my family. And when I'm gone, and I know I won't be here for a long period of time, just like all of us, we're here on earth for a very short period of time and then we go home. But while we're here, I think every single person owes it, not just to themselves, but to their family and to society, to leave the world and their family in a better place. And that is what whole life insurance does. And that is what whole life insurance does the most efficient way possible, because it can never, ever fail unless the person, the policyholder, fails themselves.
Let me talk about those 2 points. I appreciate you mentioning those 2 points, and those 2 points that you mentioned make it better than a high yield savings account or other tools or assets that you could use when you're practicing the process of becoming your own banker. And you know, I love the whole, like, if you love your family, and I've been convicted about that recently, bought a bunch of life insurance recently, and I talked to Brent about this just because, convertible term, by the way, just to just get more insurance for a pure protection standpoint.
You know that I own a bunch of term insurance, right?
I think we both love
I own
the
a lot
idea of human, and this is what I want to get to in a second. Yeah, of course, loving our families, protecting them is great. But then also just from unemotionally, if you're looking at a plan and you're just unemotional and you're thinking you're playing chess and you have different chess pieces and not all pieces move the same. And if you were looking at your financial life, your ability to earn is by far your greatest asset.
Absolutely.
So we insure our cars. Some people insure their cars even if, they'll go crazy with how they insure their cars. People would insure their homes because why wouldn't you? And yet when we're looking at your financial life, many people, including myself, were massively disrespecting the number one asset by a long shot. And so even like we could do the whole love your family legacy, blah, blah, blah. And we also could just say purely from a greed standpoint, purely from a pride standpoint, purely from an efficiency standpoint, wouldn't it be dumb to not insure your greatest asset? Like if you had a money printing machine that was cranking out money and had upside to crank out more, you would put as much insurance on that thing as you possibly could. I think where it gets a little bit weird is you may not benefit because when that machine breaks down, you might not be the one that benefits from that. But I find that if we just untie ourselves from that, it becomes really obvious. And yet there's many people out there that are like, what's the least amount of insurance can I get? Oh, $500,000, $1 million. And I want to just be like, as I know this makes me sound like a salesperson, but $1 million? Are you serious? Like what? Like the disrespect that you're putting on your name, like, so I know I'm going off on that point, but like you're like, that's really hit home for me recently. Anything that you want to say about that until
Yeah, a lot. I come across just thousands and thousands of people, just because of the size. And here's the one thing I will say, and this is a shame. We've evolved as a society into a very self-centered, greed-induced level of thinking. And to answer your question, that sole thing I just said is exactly why people think that way. And let's go back to insuring cars and houses. People would not insure their cars if they weren't required to in order to drive. People would not insure their house in most cases if they weren't required to by the bank they took the mortgage. Again, they're not in control. So they're mandated, they're required to buy those insurances. Otherwise, I think most people wouldn't, because they're just, I don't know the full psychological answer to this, but people just don't give much of a shit about anyone but themselves. And they in most cases are not trying to leave the world in a better place or their family in a better place, which is a crying shame. And listen, that's none of the folks listening to this podcast or listening to my podcast, but there is a large percentage of the population that literally they won't admit it, but that's how they go through their life, and their actions speak louder than their words. Because if their actions were true to what their words were, they would all have life insurance. They would all value their lives, their income earning potential, and protecting that. They would value all these things. They would buy car insurance, not because they have to, but because they just should. It's just a smart thing to do, and logical for that matter. And the same thing comes back to your life. So when we look at our lives, like I think a lot of people they don't think they're ever going to die, or they think they're going to die, but they're like, when I'm gone, I'm gone. I don't care. I'm gone.
Yeah.
Like, so that is pure greed, and that is just plain out selfish.
Well, and if you think
people.
multiple generations, it becomes really clear. But yeah, it requires
Our grandparents were not like that, just so you know. Like you go back to like the 40s, 50s, 60s, there was so much emphasis on a family having life insurance. I mean, listen, I know I'm speaking or preaching the choir here. The people listening to this, they're like, yeah, my grandparents bought me a policy. My grandparents bought my parents policies and made them pay for it the second they started working. Of course they did. Because why wouldn't you teach your kids that? Why wouldn't you help your kids set up that way? But in today's society, do we see that? No.
Yeah.
We see a bunch of people saying, oh, that's the worst place you can put your money. That's a stupid idea. Like, Will Rogers, I say it all the time, but he nailed it. The biggest problem with people isn't what they don't know. It's what they think they know that just ain't so. It's selfishness.
Yeah. I think if you do the third generation test and say, like, in anything, is starting this business, is investing in this thing, is doing this decision, how does this affect my children's children? I do think we would have different perspectives and make different decisions. Chris, I want to share my screen here. This has been a recent epiphany that I've had, and this is just going off of your other thing that you mentioned when you talked about earning and using, and just want to walk through this in real time with you. So there's a couple keys to better. You could make more. So obviously we can both agree if you just make more money, that's a key to just being better off financially. You could save more, which that's part of the power of the infinite banking concept, is purely take a life insurance out of it. You're creating a system that captures and creates processes to keep more of money. And so there's nothing magical. Like when Brent talks about, paying off the debt, well, he actually had to delay gratification. He was motivated by some of the shiny objects, but he still had to save more. So saving more is key. Getting higher returns. If you can earn 12% over 8% over a long period of time, that difference is big. But then the thing that I have, like, this new thing is like, okay, you could help people make more, you can help people save more, you can help people get more rate of returns, or you could give their same dollars more jobs. And it's kind of obvious to say, like, if you could give your dollars more jobs without taking on more risk, could you get better outcomes? Some people not,
There's no
because,
could. There's no could. You would.
well, potentially. I mean, I'll play devil's advocate with you. You give us control and liquidity, we'll make more. You give half of America more control and liquidity, they'll go gamble it or spend it. So I don't disagree with you, but that's an extra. Like when I asked the Ted Benna, who discovered the 401k, what he loved most about the 401k, he talked about restricting and having it hard for people to self-sabotage. I laughed inside because I'm like, that's the exact reason why I hate the 401k.
Right.
So it is interesting perspective. I do agree with you when it comes to our perspective. So this is what's interesting. These are two phones. You have one phone that's like pretty much you could get for free,
I
and then
miss
you have another
those.
phone that's a lot more expensive. They're both phones, but it's kind of a joke. They both can call, I guess, but one phone does so many more things, and it's just clear that it's like yeah, we're calling them phones, but we're almost disrespecting the iPhone by calling it a phone. And so the idea would be like, of course, like our phone is not an investment because you're not looking at a statement saying, oh, what rate of return am I getting? But it's clear to the person that's like, we appreciate efficiency. That's why even in third world countries, when they don't even have clean water, a lot of kids are walking around with smartphones. Not only is that messed up, but what that tells you is we as a world love efficiency. And so, like, for me, I'm like, okay, we get it. We're not riding horse and buggies anymore. Of course, we take airplanes when we can. We use AI. We use phones. So like we could argue that maybe phones are destroying society, but we ultimately get to our core efficiency, and yet we disrespect it in some areas. And so the two questions that I would have is, how many jobs are your dollars doing for you? And then how well are those jobs doing? And this again, I've never shared this. You're the first person that's seeing these slides, so I'm wanting to get your perspective. But then, like, let's take insurance out of it. Checking account versus savings. There's difference. That's why a lot of people have both. Both people, there's values to a checking account and there's values to a savings account. And there's, when you look at a brokerage versus a Roth, just to be clear, I'm a fan of, utilizing Roths when you can. It's not like you can put hundreds of thousands of dollars through a Roth chassis, but pro Roth over here versus just a straight up brokerage. And why? Because Roths give more checks than brokerage account. Typical investment versus real estate. We have a lot of clients that love real estate. Why do they love real estate? When set up and used properly, your real estate potentially gives you more benefits than a typical investment. That's why when set up and used properly, you can get tax benefits. You can use leverage to acquire that. It can create cash flow and it can also appreciate. And because of that, that's why there's trillions of dollars in real estate. And even like traditional insurances, usually you buy a traditional insurance to protect one thing. And so the idea is like even debit cards versus credit cards. I don't think you and I are both in favor of keeping balances on our credit cards and paying 30% interest.
Nope.
But I bet you and I both use credit cards versus debit cards because why? All the benefits that I'm mentioning on the screen. The reason I'm sharing this is like, then when you talk about a perfect asset, and this is nothing new, you start laying out what would a perfect asset be, and you're like, okay, just newsflash, no asset checks all these boxes, but a properly set up life insurance checks a lot of those. And so I'm not even taking the arbitrage like growth and use, like that's obviously part of that. But I find that the more I've learned about these benefits, the more I've realized that it's like, oh my goodness, life insurance is not an investment, but oh my goodness, it has so many jobs that it does. And the more I learn about these jobs as an it really opens my eyes to the opportunity. So I know I kind of went off there. Would love to hear your take on, because I'm trying to find ways other than saying like, bank, like I love infinite banking, just to be clear. just to be clear, I'm not trying to discredit any, but I'm trying to find different spins. And we talked about future. I'm trying to figure out different paradigms where I can at least have someone acknowledge and say, I agree with you. I might disagree with your use of life insurance, but I agree with your premise. Would love to hear your take.
Yeah, I mean, listen, like I'm pro whole life. I mean, I'm pro life insurance for that matter. Although I very much dislike the way that IULs are sold in the marketplace and speak very openly and get a lot of hate for that. But that's okay. The news flashes are coming out. But when it comes to whole life insurance and what you just mentioned, I mean, if we from a compliance standpoint, if we didn't have to call it whole life and we could just call it something else, like people would line up at our door to get it. They would literally be like, I need to get some of that. What is that thing called? Yeah, I want that. Right. But once you call it whole life, I mean, whole life has been bastardized so badly, since the 1970s, it's just hard to make it popular again. It's hard to make it sexy again, but it's always been. It's not like you're trying to dress something up. It's always been the sexiest thing in the lineup. I mean, Ted Bennett talks
It's
about it in the
because
501k.
it's because people are comparing it to an investment.
I
I
know
think
they
that's
are, but
and the
I just did.
IULs were created because we lost our way and we're like the only way to compete is to make insurance an investment, and that's the fundamental flaw in IUL. It's hard to sell an IUL not trying to compete with investments.
You're right. You're right. And I got asked this the other day. We were going over the myths of whole life and IBC. And one of them was, talking about investments. Like, when you're talking to most advisors and listen, we have a registered investment advisory. So we have advisors, but most advisors out there, if you mention the word whole life, they're like, oh no, because they want to sell you an IUL. They want to make the commission on an IUL. But the whole idea is whole life insurance is not an investment by pure definition. Google, the definition of an investment. You will find that it has to involve risk of losing money or risk of losing principal. That is definition of an investment. In a whole life policy, you cannot lose. You can't lose money over time. You just can't. Every year you'll have more than you did the year before. Guaranteed. Like that isn't an investment. So you can't even put it in the same category. The thing that I think a lot of people are doing, and this is where your book is so pivotal. I mentioned the and asset all the time. So does my team, because it is the and asset. People they should never ever compare whole life to any investment because it's this and that. You put the money in the whole life and then you buy the asset or the investment or do whatever you're going to do. And when you do that, you just gave your dollars more jobs because your money gets to earn. And I said this to someone the other day, and this will preface all those green check marks you just said. I said to him, I said, just imagine that every dollar you deposited in your bank account throughout your entire working life, just take it from age 16 to whatever age you are now. Just imagine that every dollar you put in your bank account, and even just imagine your bank account only paid you 1%. Let's just keep this super low, right? How much money would you have if you never ever lost the earning potential on every single dollar that you put into your bank account? Even though you went out and you spent that money, you bought cars, you did all these things, you spend almost every dollar you make, because that's just what we do, right? The more we make, the more we spend. But just imagine a world or a thing that allowed you to earn uninterrupted, regardless of what you did with the money. But as long as it ran through that bank account, you earned that 1%. Everybody's life would change instantly, and it would, like, the world would be a different place. But that's pipe dream, right? That doesn't happen. There's nothing on earth that can do that except for whole life insurance, especially whole life insurance from a or a non-direct recognition company. Now, all of a sudden, you actually can earn money on almost every single dollar you put through a whole life, minus cost of insurance, commissions, and policy service fees. And I love when people are like, oh, those commissions, you guys are making all the money. You clearly don't understand how this works. Why are IULs the most popular and most sold products in the life insurance world? The answer always comes back to commissions. Not so with specially designed whole life, because we take a big haircut in our commissions so our clients get high early cash value. So right there, competitive growth.
Well, so I was gonna ask you, on this list, I have a list of benefits: safe, it's easily accessible, competitive growth. And just to be clear, if I preface this, when when I'm talking to people, we talk about how IRRs works, but I usually give life insurance a yellow check mark, mainly because I want to explain to people I actually think it's green, but I don't want to lose credibility with people by saying, yes, it's like it, because we're saying it's not an investment, and yet
But I think you're wrong having that be yellow. That
well,
absolutely is green
just
because
just hear me out here. Just hear me out. So what we're doing is then I show people like, okay, in a life insurance policy, in this example, the internal rate of return is 4.5%. Okay,
tax
4.5%.
free, 4.5 tax
Well,
free.
okay, yeah, you're
Sorry, I don't mean
clearly
to
not
jump ahead here,
understanding
but
because
like
you're like
we
literally
have to
playing
call the elephant
into.
in the room out. Like that's not 4.58% return because everybody's like, that's okay. It's better than my bank account. That's way more than that because you're not paying any tax on that.
So hey, I promise I didn't talk to Chris before this. If you include the tax,
Oh, I did. Yeah, I didn't see this.
So check this out. We're taking all the benefits that are green, and then when I'm calculating it into our calculator, I'm taking them out because the calculator is now taking that benefit and bumping up the rate of return. So what I'm saying is, if you just look at the 4.5%, you could
That's
say, okay, this
good
is
return.
better than a high yield savings account long term. So we're already smoking the savings account. But Chris, I'm going to say something you're going to probably disagree with. Mathematically, if I could own, if I didn't care, if I only cared about growth and use, and I had an account that was earning 4.5%, and I could borrow at 5, no other benefits, I'm an idiot for wanting, even if it's uninterrupted compounding. If I'm only earning 4.5 and it costs me 5 to use, and there's no other benefits, personally, I would. That's an equivalent of a negative 0.5% account that I'm putting my money in.
Uh-huh.
Do you agree or disagree with that mathematically?
I agree with it from the surface. Yeah.
Yeah, I know human behavior and all. Okay, but this is where, so then when someone's like, okay, Caleb, you talk about life insurance not getting necessarily cash on cash arbitrage. Why are you such a big fan of life insurance? Here's why. You just add taxes alone. Now, I'm adding 30%. There's some people in the state of California, in your lovely state of New York. Congrats on the new mayor, by the way. And now
Yeah.
it's like, okay.
What? Congrats on the new New York City mayor.
Yeah, I know you're
Yeah.
not in New York
Uh-huh.
City. The equivalent rate of return, and I have to explain equivalent rate of return. Chris and I are not saying that life insurance is getting a 6.5%. We're just saying when you factor in what you would have to pay in a high yield savings account, because you have to pay ordinary income tax on
But
these
you're
type of
also
benefits.
you're only assuming that the majority of the people listening to this live in states where there's no state income tax. I
Well, I'm
happen to
also
live in
assuming a
the
30%. Not
beautiful.
everyone's in a 30%.
Yeah.
The beautiful thing about the calculator is you can bring it up to 50 or 60% if you want. You could bring it as low as 0.
But just look at that. Let's just use this because this is like pretty lowballing it, right? Because most states do have state income tax. So you're pushing north of 30%. But let's just go to 6.54%. That is what you'd need to make in any taxed investment, including a high yield bank account, a tax, treasury bond, treasury bill, anything but a muni bond. You'd have to earn 6.54. And I'll be honest, I have not seen any muni bonds that pay anything close to 6.54%. But yet people, like especially wealthy folks, always run to muni bonds because of the tax advantage,
Yeah.
the tax advantages. But here, this is tax advantage. You're making 6.54.
Well, and muni bonds doesn't have a chronic or terminus
No,
illness
it doesn't
rider.
have any of those things.
Muni
It's
bond
just
doesn't have
got tax-free growth, and there's even caveats to that. Here, you always have tax-free growth as long as it's built properly under the MEC 7 pay. But now, let's ask that same question. If you had an account that you could earn 6.54, but you could borrow from that same account hypothetically for 5%, would you borrow from anything else? You'd be making a positive arbitrage on your money every time you used your money. Like, of course you would use it.
Exactly. And that's the thought of, like, and we're just getting started. That's the beautiful thing about this is when you
Fired up
when
here.
you add cost of insurance, when you add a potential fee, we also can go as far as we can look at what a long-term care policy would be. We could look at what it would look like to get the creditor protection that you're already getting in life insurance. Then we can run a risk-adjusted return. And I'm telling you that what I'm not saying is that life insurance is going to get close to 8, 10, 11, 12%. That I'm not saying that it's going to get that in your cash on cash, but what I'm saying, when you start looking at all the benefits that you get, look at all the green that is still not being used right now. And so I'm making your point. While I'm saying life insurance does not give you a cash on cash arbitrage, when you look at all the other benefits, hence going back to, if you could give your dollars more than one job and you understand those jobs, well, those jobs now have value. And if you don't tie value to those jobs, then you're not being intellectually honest with this whole conversation. And so normally when people talk about life insurance, they're purely looking at the cash value. They're comparing it to a hypothetical maybe average rate of return that they potentially could get in the market, and they're not including any other jobs. And if they were, I'm still cool with someone saying, I still don't love this play. We can agree to disagree.
Mhm.
But for you to make all the talking points that are being said on like Dave Ramsey's show and all, it's intellectually honest when you're working with someone that's setting this up right. Now, just going back, and here's the actual calculator, and let's just do this in real time. I'll let you run the numbers. What do you want the cash IRR to be? Just tell me a percentage.
Yeah, do 4.1,
4.1. What do you want the tax rate to be?
28. Well, actually, if
28.
we're including state, hold on, because I'm going to include modest state. Do 33.
Okay, I will do 33. I just want to show it's already, without even including taxes, it's already outperforming high yield savings accounts over the last 30 years. Slightly underperforming bonds, but check this out: 33%. Boom. Right that there alone, this life insurance policy with the inputs that we've put, the equivalent value crushes bonds and high yield savings account. What do you want to put for management fee?
Well, I mean, 1.25 is pretty average on any brokerage account with an advisor.
Okay. So cost of insurance anywhere
I think
from
your 10% was spot on. I mean, that was maybe low.
Yeah, if what I love doing, if we're talking to people in their, who want actually life insurance, we could look at guaranteed universal life, and
Mhm.
that's around 40%. But this is the whole buy term invested difference. You're going to drop your term policy
Yep.
10%. Okay, chronic illness rider. Let's
You could
put in let's put
put
in
zero. I don't know.
okay,
I mean,
put in
because
zero.
it's,
Creditor protection. This is like if you wanted to buy extra insurance to protect your assets,
oh,
or if you
what would
wanted
that
to
cost?
buy entities that actual shield your money.
At
And
least 1%, maybe.
okay, that's going to barely do anything. Okay, so we're right now at 8.3. This last thing that I've done is we just did a risk adjusted, and we're just assuming you could earn 4% risk free. And anything else, if we're assuming 8.3, you'll need to take on risk, and we're just factoring that in. So
Mhm.
the equivalent value in our inputs are 8.3%. If you do risk adjusted, 9.2. My question to you: where can you earn anywhere close to this and have liquidity and control? Like where what other asset that you can have liquidity and
No, none,
control?
none, none. The answer
My
is
point exactly.
zero. And I know there's a lot of people listening that will hear this and they're like, well, the S&P 500. Just stick around for the show a little bit longer. I realize that this is the longest bull run in history. I realize that people over 30 or under 38 years old have never felt the impact of a recession, but just give it some time and you will. And then you will understand that the S&P 500 heavily weighted on 7 stocks. Like I think it's like 60 to 80% of the gains of the S&P 500 are from 7 stocks. Like it ain't gonna do this.
Well,
It
even
no
it,
way.
but the reality is, it's like, well, if you're such a big fan of the S&P, then just take a loan against your policy and put it in the S&P.
Yeah,
Like
I get
the
it, but people
S&P is
don't
an
even understand
investment.
the S&P 500. It's almost become like a buzzword. It's almost like the equivalent of saying, "Oh, you got a toothpick." A toothpick is a brand name. Like that's almost how people are looking at the S&P. They don't even understand it. But I get it. I
Yeah,
totally get
my
it.
my argument would be insurance and the S. If you're such a big fan of the S&P, which you clearly are not, but if I am talking to someone, it's like, does insurance enhance your S&P deal? Like,
Absolutely. You just proved it. You just showed the mathematics behind how whole life insurance improves your returns of the S&P 500 without taking any more risk.
yeah.
It's not like, you don't have to go out and buy options or derivatives to try to boost your return on a stock. Like you're automatically getting that.
Yeah. The crazy thing is we factored in probably 6 benefits, but remember that list, there's still a lot of green benefits that I cannot figure out how to calculate. Because how do you calculate safety and guarantee? I don't know how to incorporate that into an IRR other than the fact that that is a benefit
Mhm.
that not even all savings accounts have. If you have $2 million in a savings account and only $250,000 FDIC insured, then you have to live with the fact that if that bank goes under, all that money is not technically guaranteed. And I know someone could say, well, life insurance companies going under. Yeah, buddy, we could have a conversation all day long
Yeah.
about the safety of your money. I think even the people that hate insurance the most aren't using that card around. Oh, and these mutual insurance companies are going to go under.
I proved it a long time ago. I did a video, the history of IBC, and basically just went back in time to find all the people who have used whole life insurance. And really the origins, as much as I could figure it out, were the Rothschilds, the Rockefellers, the Morgans, and the Stanleys, to which all were bankers. And why did they put money in life insurance companies? Because it wasn't common back then to do this. They did it because they were just safer than the banks. That was it. That was the sole reason why they did it. And then because they had the money in the whole life, they knew that they could use that money through loans, and they started doing that. But it was not because of the loans that they did the whole life. It was because of pure safety of their principal. Banks couldn't be trusted back then. They shouldn't be trusted today.
Chris, with the time that we have left, talk to me about why you use IBC for cars, because that's probably the biggest disagreement we might have on the internet.
If you're a high income earner or own a successful business, you're already creating real value in the world. The real question is, are you keeping that money, protecting it, and growing it the way that actually supports your long-term goals? At BetterWealth, we help people like you better keep, protect, and grow their wealth through various tax strategies, estate planning, specially designed life insurance, retirement planning, and even a fractional family office service. If you're interested in one or more of the areas we can serve and want to learn more, the next step is to book a free clarity call with us. Click the link in the description or tag comment below to get started. Back to the video.
Because I bought a lot of cars in my life, and every car that I used to buy, for the most part, I would always finance them. I had this relationship with a credit union here, and literally, like, I think I did like 40 car loans. I held a record there for a long time. And when I learned about the infinite banking concept, it was so simple to me. It made perfect sense. You change one thing, where your savings goes first, because I was already saving money, not a lot back then, but enough. And then add one step. And that step was just, I like to call it Monopoly, right? I'm just playing real world Monopoly. I'm moving my little chess piece, or my little piece, around a Monopoly board. And every year I'm passing go, which means I get a dividend. But along the way, I'm finding jobs for my money. So I'm relating this back to yours. So as I go around Monopoly board, okay, which is the equivalent of 12 months of the year, what I'm doing is I'm finding places that I can make my money go to work. And then I'm putting some money into various things, some real estate, some private lending, but cars, right? I have a family, and I collect Porsches, so that's a problem. But we also have 2 cars in our family that we drive every single day. And I just simply did the math. I did the math on how much money it would cost me to finance those at the lowest offered loan rate out there in the industry. And when I started doing that, I was kind of astonished.
What interest rate was it coming?
It depends on the time period when I did this. I mean, going back to when I first started this 10 years ago, you get a car loan for 3-4%. Now today it's like 6, 7, 8. Well, keep going. I mean, but that's where you're at. But back then it was 3-4%. But here's the thing. When I added up how much I was paying and losing, on cars, it was pretty astonishing at 3-4%, which you cannot get a car loan today at 3-4%. So then what I did is I literally just ran the math of, what if I did it through the policy? And what if I just paid myself back the exact monthly payment that I would have paid a bank? And this whole first thing, I did it with several cars, but the first one that I really documented was when my wife, we found out she was pregnant. I bought her a Porsche Cayenne, because the car we had was just always in the shop, and it just wasn't a reliable vehicle. So we bought her this Porsche Cayenne. He was used, and we were negotiating with the dealership. And I remember she got so mad at me because she knew we were paying cash for the car through a loan with our policies. But I was playing this game with the sales guy, and he'd go back to the manager, come back, slide me over the rate. I say, no, you got to beat this. And I was just playing off the monthly amount. I wanted the lowest monthly payment for the car. This is how everybody buys a car, and this is why I did it. 3 or 4 times back and forth, and he slides it over. He says, Chris, I'm sorry. This is absolutely our final and best. There is no better offer we can give. And I look at my wife, and she's just still pissed off, because I'm just playing games. And I said, yeah, I'll take that. And he's like, great. I said, you got a deal. So he then slides this big pile of paperwork over the credit applications. I said, and I slid it back to him. I said, I don't need this. And he said, well, why? And I said, well, because we're paying cash for the car. I said, I'm doing this through my private banking system. And he says, well, why did you have me going back? He was actually pretty pissed off. And at this time, I did not know dealerships made money on financing. I just thought this was just a convenience they did to get people to buy the car where they made the money. No. They make money on the financing. And later I found this out that I actually kind of screwed him because he had negotiated the price of this vehicle down because they factored in that they were making money on this financing, to which I just stripped him. So he then says to me, he says, well, why did we do all that? And I said, well, because I had to figure out what the lowest monthly payment would be for me to pay my bank back at, my banking system. He didn't understand it then, but like that was the whole thing. So when I buy cars, I always make a car payment, but I make a car payment back to myself. So like, let's just take the policy right out of this. Okay. This is where I get a lot of hate. The infinite banking concepts is a process. Yes, they include the whole life insurance policy because it makes it more efficient, but it doesn't have to be included to have the infinite banking concept work, the banking function, if you will. You could use a bank account. You could use a 401k. So if I just did what I just explained with a bank account, I saved up enough to buy this Porsche. I paid cash for the Porsche. I made the exact car payment I would have made to the Porsche dealership, but I made it back to myself. Well, I'd get all the money back for the car after 5 years plus the interest. So then when I started doing it with the policy made it just a wee little bit better. I had a little bit more money. And plus, I had a death benefit. And plus, my money was protected from judgments and liens and all those green check marks. So you can agree to disagree or just agree, like it's just a more efficient way to buy cars. And I have bought no less than 20 vehicles using this system. I've gotten money back on all my money back on every car. And now I even play it now. Like I got a G-Wagon right here that I just sold. Kind of a stupid overpriced vehicle, but nonetheless, I financed that one through. I overpaid for the vehicle. I did.
Yeah.
Like, because it was after COVID. I overpaid for it. I knew I overpaid for it, but it didn't matter because I knew if I made payments back to my bank, I would close that gap. So I just sold the vehicle for $134,000, and most people would have lost 40 grand on that deal from what I paid to what I did. But I actually made money because I was ahead of the game because I used the infinite banking concept to buy it. So that's why.
Okay. Can we hash this out as we land the plane?
Sure.
Okay. I think you know how Nelson talks about volume versus rate?
Yeah.
And I think the pure goal is to help people save more money. And so there's no doubt when people are motivated by things like cars, they will find ways to just save more. So I want to acknowledge that. And then I want to talk from just a pure mathematical standpoint.
Mhm.
So we both have cash value available. And I could, let's say I'm going to buy a car and my policy is at 6%. I'll just say that I can access it. I'm gonna play both ways here. And let's say I could get a 4% loan, and my whole goal is to save more money to increase the capital. I will be able to have more money for the Guilliams Capital Life Insurance if I take the bank loan, take the difference, and put it in forms of PUAs or premium.
What I didn't catch something to take what difference?
So this scenario number
6
one
to the 4?
Yeah. So if I could borrow at a car dealer at 4%, and I could take a loan at 6% from my personal bank, I would be better off taking the 4%, taking the additional 2% that I would have paid the insurance company, which is not wrong. They're not, but it would go to the insurance company, not me. And I would have more money in that scenario. That's where it's like
I could prove you wrong.
No,
mathematically,
you can't. Chris,
every day.
respectfully, you can't because this is like pure math.
I know, I know the math, but I could because you're missing a key component.
Do it. This will be like the
Well, we have
greatest thing for your
software. We
channel
have
because we'll
software
just
that
like
does
come up.
that.
But like,
so I can explain how,
because that's not how the math works.
Well, it does. So hold on, because when you take the payment, okay, that you're making, so take your car payment that you're making at 4%. If you just take that same exact car payment, because you could get a loan from the bank at 4%, so don't make your loan more just because your policy loan interest rate's 6. And if I took that loan payment and I paid it back to my policy, recycling and recapturing it as a loan repayment, what happens is after 1 year, I didn't pay 6% to the insurance company because I've been paying down the loan. So the APR is more like 4% at that. Second year, I'm doing the same thing. My APR, because I'm paying interest, simple interest on a declining balance, the APR is now in the low 3% range, and then 2% the next year. And I'm working off of a 5-year loan. So when you average that out and you average the APR, the interest you actually paid to the insurance company, not the interest that the insurance company was charging, you are way ahead, even at 4%. Mathematically certain.
Okay, can I be a little late? Late, and then and I have time. I don't have a hard
I'm happy to show the math. I need a calculator. You got a calculator at your fingertips. I don't.
Yeah. So let me just do
because you got to
share
factor in what you could earn on that 2% difference and roll that back into the equation. But I think you'd be hard pressed.
I'm assuming the same thing. So this is where this is where I think and this is not a get you. This is probably the one biggest
Oh yeah,
thing.
no. Because go ahead.
You know me. I'm not here trying to. Okay, so you have. Okay, we're gonna do Chris and Caleb, right?
Mhm.
You have Chris and Caleb. Okay, just to make math extremely simple, we're gonna say the payment, and let's say we have cash value. Can we both agree that let's just say these are identical policies?
Sure.
So we have cash value over here, cash value over here. Okay, we're gonna let's say the payment is $1,000. So the
simple math. $1,000 a month car payment.
We want to buy a car. Okay. And let's say and we're already funding our policies, so none of that is going to change. And let's say the car dealership over here will give us a payment at $1,000.
Yeah, call it 4% interest.
Okay. So $1,000 payment. Or I could take a policy loan at $1,200. Just assuming that it's a little bit higher interest rate.
Well, yeah, but don't assume it's a higher interest rate.
Well, that was my first assumption is 6% versus 4%.
See, I wouldn't do it that way.
Well,
I would pay myself my policy back the exact amount I would have paid the bank, and if the bank's offering a loan at 4%, I would pay myself exactly what the bank was offering and the dealership was offering.
Well, okay, so but that's just that's a talking point that I've never heard before because I don't. So I.
Well, I think it's silly. Nobody in their logical mind would pay more just to pay it back to themselves when they could get it cheaper from a bank.
Okay, so you do agree with me that
100%.
in this scenario, you would take the bank?
No, I would not.
Okay.
We haven't got that far. But what I'm agreeing with you on is the $1,000 car loan that you could have got from the bank. Okay. I would only, if I was doing it from my bank, my policy, I would only pay my bank back $1,000. I would not pay my bank back more. Like that's,
so you would
pay,
even if your interest rate was at 6%, you would pay an equivalent of
because what I just explained, it won't matter in a second. But yeah, but just put $1,000.
I think that's a person. I don't necessarily think that matters to the equation. But okay, so here we go. So Chris, in this scenario, you're going to take a policy loan, and again, like just hear me out. You're going to pay $1,200. Trust me, I'm not going to be weird with math. I'm going to take the $1,000, and Caleb over here is going to put an additional $200 into my policy. So we're the same cash flow is the same, but Chris, I'm telling you, over time, Caleb will have more money than Chris in this scenario, because
this would be a cool part too, because we can model this.
Yeah, but Chris, there's nothing to Chris, you're paying back a loan. These are the same. This is identical policy. What's going to be better? What's better for the policy? A loan repayment or new premium?
Okay, that's a simple one. A loan repayment in this scenario would be better because you're talking about a 6% loan rate. So if I'm repaying the policy, but see, the difference is, and I know how you're modeling this, and you can continue to model it this way, but I would be paying my policy back $1,000. If you're saying the cost is $1,200 at 6%, because you're saying that the 6 versus the 4 is a $200 delta. Okay, so that is true the first month. But the second month after I make $1,000 payment back to my policy as a loan repayment, that is not true anymore. And then the next month, so every month I'm paying $1,000 back, which means the insurance company is no longer charging me $1,200. They're charging me with the 6% on whatever the declining balance.
The reason why that does that it's a half truth, respectfully, because you're not wrong, but you're not
I'm
you're not
100%
including
right.
opportunity cost. You're looking at
Right.
you're not looking at,
I'm not talking about the opportunity cost at this point. I'm just talking the math
right.
on
What
the
I'm
top
saying
part.
is this is what I'm saying.
You're talking
Like,
about the $200 going into the policy. Is that going to outweigh? I've never run the math on that, but I'd love to.
But it's not like we don't even need to run a calculator, because just do the logic. If we have the same exact policy,
Mhm.
I'm not talking about I'm just talking about the same exact policy, and we have $100,000 in both.
Mhm.
Okay, you took a loan from, and let's say non-direct recognition. So you took a loan again. So I technically have more capital than you to begin with, because I'm taking their money over here. I'm holding on. Now that could be a good thing or a bad thing. As an entrepreneur, I'd rather have the money and options. I
I'll
feel like
agree
I have
with you.
more options. That's a
Mhm.
different talking
I
point.
agree with you on that.
So then what in this scenario, if we're taking the same 1,200, Chris over here is putting all 1,200 back to repay back the loan. Okay. Whereas remember, like, your policies is going to be identical. These policies are growing identical. All I'm doing is Caleb, am putting an additional 200. So
Into
not
the
only
data
do I
addition.
have all of my 100,000, whereas you're now paying back, getting back to that 100,000 of liquidity. Our policies are growing the exact same. The only difference is I'm adding 200, and logic would say I'm adding 200 to this scenario. I'm going to have more money over time.
I'm not going to agree. I will run the math, because it,
Okay.
to me, is not as logical as you're making it out to be, because you're using your numbers and your logic. I get it, but I'm just a mathematics guy. That's why we created the Vault software, is to prove mathematics and to run multiple scenarios in one particular example using the policies. So this is a very simple thing, and I think it would be a sweet second podcast to kind of just hash this out. Now, I'm not saying you're wrong.
Yeah,
I'm just saying let's let
plug
Matt
that in,
prove
and then
it.
maybe on the next episode, like, I'll even talk like from a math standpoint, but then I could even make the argument, and I would be wrong. I could make the argument that let's just say this payment's 1,400.
Mhm.
1,400. I could still make the argument that I would still take the loan from the bank, even though mathematically I would be less behind, because it would be obvious that you would now have an additional 200 that you could put into your policy, apples to apples.
Mhm.
You would actually be ahead, and we could have a conversation around, like, why would I take precious capital, put it into a depreciating asset, or an asset, doesn't matter, that a bank will give, when, like, I have access to money. So
Yeah,
for me,
can
that's a whole different. That's not I'm admitting that.
Yeah,
in
that is a
scenario,
personal preference thing. That really is, and I can
Yeah.
I can answer for myself, and I've gone public, on my YouTube and my webinars explaining this over and over. Several years ago, like when I started buying the Porsches, I've always loved Porsches since I was a little kid, and I never had one, so now I have 5. But it has nothing to do with the Porsches, okay? So please don't hang up on that. What it was for me, I saw a declining economy. I saw a future investment world that was not safe and was not secure. And I was pulling money back out of investments, okay, real estate investments, selling real estate, closing out loans that I had done on that. And I had all this cash value. And I did not have anywhere for that money to go to work. Okay. I have no debt. Outside of my mortgage, I have no debt. Okay. So I was in a kind of, this is a personal thing. I needed to move money. I needed to do something with that money. So I started using it to buy this car collection. And also, this isn't why I do it, but this is just at that point why I bought more cars with this versus investing that money or versus financing it. I needed to move capital. Okay. Now I know that doesn't apply to some of the people listening. This is a personal preference, and every client, every person listening will have a personal preference on where they move money and what they invest in. This was just mine. It was the safest place, because right now, if I go to a bank, a car loan 6%, if I pay myself back at the same exact rate I would pay on a car loan, 6%, that to me is a good return on my money. It really is. And the arbitrage, if you will, from what I pay the insurance company, the cost of capital, to what I'm earning on the 6%. So most would say, well, if you're paying the insurance company 5 and they're charging, and you're paying the loan back at 6, you're making a 1-point spread. I'm making way more than that because of the velocity of money and the APR. The APR is the number I'm using.
Yeah.
So every year I'm getting a higher and higher return on my money, and I'm taking zero risk. So for me, the cars is really just maybe a privilege that I have where I have capital to do this that isn't going to affect my outside business, investment, capability. So I have liquidity. It just, to me, was a better place to move money than anything else that I could find.
Yeah. So you would agree with me that if someone had a liquidity choice between an asset or a liability, that they may be mistaken if they take all their precious
For cars,
liquidity
yeah.
and put it into a car.
The thing I would actually, and I've been talking about this with Devin a lot, is one of the things right now, there are a lot of cars out there that lease out phenomenally well. Like I'll just use Jeeps, for example. They have a really high residual value. So if you go to lease a Jeep, like you could get a $60,000 Jeep for like $600 a month. If you were to try to finance that, that's over $1,000 a month. So like I would tell people, all right, listen, like if you got the money in the policy and you have debts or you have something else we can use the money in the policy for, go lease. Find a vehicle that leases really well from a residual standpoint, negotiate down the factoring rate, which is the interest rate they charge in a lease, and get a good deal on a lease. And then you're driving a brand new car, you feel good about it, but then take the difference from what that lease is that you're paying and what you would have paid yourself back at, which is a going financing rate, which is about 6% right now, and then reinvest that back into another policy. Then you'd certainly be ahead. I think there's a lot of ways to play that. I've never really gone public with that, so this is the first time I've mentioned that, but we talk behind the scenes about it all the time. I don't think that's a bad strategy at all. I just think people make a lot of mistakes. So it's from the public standpoint, it's just easier, and I think you can respect this. It's just easier sometimes just to teach the one way, and then people can kind of figure out the logic behind what's best for them, or work with us to figure that logic out later.
I think that's what Dave Ramsey, I'll give him flowers. He's very consistent. I think behind closed doors, he's not an idiot. He knows if he can get a 0% loan,
behind
put it
closed
into
doors, he owns
treasuries.
whole life.
If you can 0% loan put into treasuries, you're not really taking on any risk. But he's being consistent because he knows when he gives an inch, people get more confused. And what you're saying is, hey, like every case is going to be a little bit different. But I had Carlton Dennis on the other day, and he's talking about like, hey, I'm not giving tax advice when I'm on TikTok. I'm getting people to think different. But obviously, when they work with me or our team, it's every situation is going to be the same. But I'm trying to like inspire and tell instead of telling them no. And I do think, to your credit, there's many people that are starting to save more because of the desire to buy a dream car. And by that desire, you're getting them to save $3,000 a month instead of their $1,500 uninspired. And it's really hard to compete if you're increasing someone's savings rate. That's not a math problem. That's a heart problem. And
That's
it's
true.
a motivation.
It's an emotion problem, and that's the most powerful thing when
Yeah.
it comes to money.
Chris, thank you. I look forward to coming on your show and
Absolutely.
jamming more.
Sounds great.
I only went for a day, and that was my biggest regret because people start to see something in themselves they haven't seen before.
I'm just so grateful.